Good morning, everyone, and
Morning.
welcome to our DAT Weekly Market Update. This is our update for March 22nd, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist. We have a special guest, Todd Amon from ATBS, and live on scene at the Mid-American Truck Show, we have Dean Croak, who's our Principal Industry Analyst. Good morning, everyone.
Morning.
Good morning.
How's it going?
Pretty good.
Yeah, I mean,
No complaints.
I could complain, but the weather here is 70 degrees and sunny, so not so much.
Just rub it in. Just rub it in. We're supposed to get that, those tornadoes, that system that was working its way through the south is blowing up here, and we're supposed to go from thunderstorms to heavy wet snow on Sunday. So it's a typical Ohio April.
Yeah.
April?
We'll see the same
it's not
here.
even April yet.
March. Yeah.
We'll see some of that in Louisville here.
Yeah, that's probably coming through your way this week, right, Ned? Or Dean?
Yeah, I sort of joked last week that when you go to a truck show like this, you'll see 4 seasons in 1 week, and it looks like we'll see at least 3 of those seasons this week. There's no snow predicted, but we'll definitely have rain, wind. I got sunburnt yesterday, so I've ticked that one off.
Whoever had that on their Dean bingo card. He stayed at a Cleveland airport no-tell motel. He's got sunburn. I wonder what else on the tracking Dean bingo card we have.
Yeah.
All right, so let's get us moving.
Anything. I didn't break anything on the way down. Always a good sign.
That's solid. Well, I'm really thankful to have Todd here. Todd's a repeat guest. It was a huge hit when we had him on last time. Right. I'm going to turn it over to him real quick to do a reintroduction of who he is and ATBS and why we love having him on the show.
Hey guys, thank you for letting me join you this morning, and I always enjoy the conversation. You guys have some amazing data we keep up with, and at ATBS, just a brief recap, we've been around for 23 years, and our business is really just helping owner-operators run their business. We do their books, we do their taxes, and we do business consulting. So we spend every day just talking to drivers about how they can make more money and live a better life, and we do it for about 20,000 drivers. So we have a real good kind of glimpse into every day what's going on in the world, and I'm sure we're gonna have some fun conversation today because the world has changed drastically over the last few weeks from what we've known for the last almost 2 years, and the times are interesting, as they always are.
For sure. So we'll get back to Todd after we run through our market update, but last time we had Todd on, we ran short on time for questions. So if you have questions, please drop them in the chat or comment section below, and we will be sure to try our best to answer those at the end of the show. But with that, I am going to jump into our key trends so we can get moving here. Drive-in and reefer rates, spot rates have plunged. This is something we talked about several weeks ago as a very distinct possibility. It seems to be happening. Largest week over week drop since 2020. Load to truck ratio is really at 2018 levels and pointed downward. We're seeing overall spot market traffic down considerably. New truck orders down month over month and year over year. Again, big backlog there. I wouldn't read too much into that one. The sub bullet point here, I think, is the more important one, which is used sleeper trucks, 110,000, pushing 111,000 last month, which is wild to think about. And then getting a head start on thinking about Road Check Week, which is the 17th to the 19th of May this year. I don't know what wheel ends are, but I'm sure Dean will tell us when I turn it over to him. Dean?
And it's anything to do with that end of the wheel. It's, slack adjusters, rockers, all sorts of bearings. It's everything to do with the wheel end. So they'll be vigilant this year in particular. Let's dive into the weekly market update. Remember, we'll do a brief one today, but the weekly report is published Wednesday evening. Just go to dat.com/market update for all of the details behind what we're about to cover, including this is the 5th week that driver and load post volumes have been decreasing in terms of the load to truck ratio. It's the first time actually the year over year comp of the load to truck ratio went negative this year. The load to truck ratio is now down to 4.44, slightly lower than this time last year. In refrigerated, load post volumes are down again, about 15% lower than the previous year. Carry equipment posts remained relatively flat though, so it left the load to truck ratio in the reefer sector largely unchanged at 8.09. The flatbed sector, having a look at the load to truck ratio, it's the only equipment type that's really following seasonal patterns, as you can see from the chart, tracking closely to last year in 2018. Load post volumes are up last week. Capacity was relatively flat though, so it left the load to truck ratio largely unchanged at 89.26. Having a quick look around our markets, we'll start out on the West Coast in Los Angeles. Load post volumes jumped 32% week over week after a month of declining volumes. Volumes look like they're starting to climb again as import volumes start to come back from Asia after the Lunar New Year break. Outbound truckload volumes on the West Coast are tracking closely with those container volumes, so keep an eye on those in terms of volume in that particular market. Still, though, in a reversal of last year's tight capacity in Los Angeles, spot rates continue to drop. Last week, they dropped 14 cents a mile for Los Angeles outbound on the high volume intermodal lane where truckload competes heavily, Los Angeles, Chicago. Rates are now 26 cents a mile lower at $2.17, down 84 cents a mile since the start of this year. And in the large e-commerce warehouse markets on the Northeast coast, capacity loosened last week in Harrisburg and Allentown. Rates dropped 19 cents a mile and 13 cents a mile, respectively. Having a look at the refrigerated market, capacity was very tight last week in southern Texas. Outbound rates were up 18 cents a mile to an average of 286 in Houston, San Antonio, and Austin combined. That's 286 up 18. In Houston, load post volumes have jumped 24% since the start of March, but capacity was very tight on the 1,200-mile haul to Phoenix. Rates on that mile are up 45 cents a mile last week. That's over the February average, averaging $2.17 a mile, excluding fuel. And of course, there was higher demand last week as we forecast the week before, ahead of St. Patrick's Day. A lot of cabbage comes out of the Jacksonville market. Rates are up 7 cents a mile to $2.61. Capacity eased, though, a little bit of a surprise just south in Lakeland. It's normally a bit busier this time of the year. Reefer rates dropped 10 cents a mile to $1.85. Having a quick look at the flatbed market, California was tight again last week for the second week in a row. Spot rates are up 11 cents a mile to an average of 218. Same story in Portland. Rates are up 18 cents a mile to 308. Load post volumes are up about 24% last week. Load south from Portland to Stockton up 22 cents a mile, averaging 299. And in our largest market for flatbeds in Houston, rates decreased by 2 cents a mile to 283 last week. But notably on the high volume lane where the most loads move from Houston to Fort Worth, rates were down 7 cents a mile to 317. Wrapping up with our year-over-year look at spot rates, dry van plunged 13 cents a mile last week. That surpasses even the most significant decrease recorded when demand crashed at the start of the pandemic. Rates now down 25 cents a mile in the last month, ending last week at 243. Just 9 cents a mile higher than this time last year. Similar story in refrigerated. Rates have dropped 28 cents a mile in the last 4 weeks, down 13 cents a mile last week also. This is the most significant week-over-week decrease, as we said, same as the dry van sector. Fairly big drop considering that diesel's gone up and margins are being compressed, which we'll get into with Todd in a second. The reefer national average rate ended last week at 275, just 14 cents a mile higher than this time last year. And wrapping up with flatbed, after increasing for the prior 3 weeks, flatbed spot rates dropped 4 cents a mile last week, erasing all of the gains over the previous month. Ended last week at 268 per mile. That's 28 cents a mile higher than the previous period last year, and about 46 cents a mile higher than the same week in 2018. So that's it for this week's market update. Remember, go to dat.com/market update to download the more detailed report. And with that, it's over to Ned for the short-term forecast.
Hello, everybody. I was in charge of actually making the charts this week. Normally, I just make the numbers, so if they look a little different, my apologies. I'm not quite up to Dean's chart prowess. So anyway, beginning with the dry van, you can see in blue the market rates observed by DAT, and then off to the right, you can see our model suite. Here, it's looking pretty rough for people who depend on high rates, with the short-term forecast dropping by, looks like, about 30 cents on that order over the next month in the short-term forecast. The blended forecasts in gold and silver are a little bit less quite so aggressive, but they're still pretty significant drop over that period. Ratecast is expecting the drop to ease a little bit, but the overall trajectory to maintain itself, which is pretty aggressively down for the near future, with Ratecast expecting rates to drop by about 20 cents over that period. Moving next into reefer. Reefer there's a lot of model divergence here. In the blue, you can see the market rates observed by DAT, and then off to the right, you can see in red the short-term forecast expecting rates to drop by, looks like, about 50 cents over the next month. Meanwhile, in green, Ratecast is expecting the decline to halt at least a little bit and pick itself up, although rates will end the next month, ending April, down about 5 cents over that period. Finally, in gold and silver, you can see the blended forecasts, which are mixtures of those two in different amounts and in different ways. And they're agreeing more with the short-term model, having a pretty aggressive drop over that period. Looks like about 30 cents over the next month. So hold on to your butts. Finally, moving into flatbed, here we have a little bit more, less dramatic charting. In blue, you can see the market rates observed by DAT, and then off the right, you can see our forecasts. In red, the short term is expecting rates to stay more or less flat, maybe rising by a couple of pennies as we head into the later part of April. In contrast, Ratecast is expecting a drop of about 5 cents over the next few weeks, and then a pick back up as we head into April, landing a couple of pennies below where we are. And then the two blended forecasts are kind of splitting the difference. Since neither forecast is particularly aggressively up or down, they're kind of hanging out in that middle region, although the blended forecast in silver is leaning a little bit more towards Ratecast, while the blended forecast in gold is leaning a fair bit more towards the short term. And that is it for our forecasts. Which brings us on to the DAT IQ question of the week, which I have written down. Do rising fuel prices make the spot market less attractive for carriers?
That's an interesting question. Thankfully, we have an expert sitting here to help us start that discussion off. You want to kick us off, Todd?
Yeah, well, how long do we have? Because we could talk about that all day, I think.
I thought it was all based only on primary acceptance rates being higher.
Yeah, that's such a crazy question. I mean, at the end of the day, in the short term, yeah, I think obviously the market probably can't keep up with the shock that we've had to the cost of doing business over the last 3 weeks. When you have fuel prices, I was looking at a bunch of data yesterday, and you guys know this, and I think you've talked about it. Fuel prices went up $1.15 in 2 weeks, and that's never happened in history. If you go back and look at 2005, Hurricane Katrina was kind of the first shock to the market, and fuel prices went up the highest in a 2-week period, 40 cents. In 2008, similar thing. The Great Recession, for whatever reason, fuel went up when we had a recession, went up 40 cents, and so fuel's gone up 3 times what it has any other time in history, and we just don't know how to react to that, right? The cost of doing business just went up $400 a month for the average driver, and so market rates can't keep up with that. Because of Hurricane Katrina, almost 20 years ago, we built a really good hedging mechanism in the fuel surcharge in our industry, because carriers were literally going out of business back in those days. Every day there was no fuel surcharge to offset it. So it'll come, I really believe. If we take a daily view and a weekly view right now, it's a dire situation. But at the end of the day, we still have a supply-demand imbalance. The Ukraine war has thrown a wild card at us, and we don't know what it means yet. We've leveled off in fuel last week to this week. And so if we start seeing some flattening and rates catch up over the next 2 or 3 weeks, I think we're fine. Fundamentally, things didn't change since the war. We still have not enough trucks. We can't make enough trucks. We don't have enough drivers. There's still a great capacity imbalance with the supply of freight that needs to be moved. And so unless demand goes down tremendously, because everybody in America is now paying a lot more for their fuel, and we stop buying because we expect change because of this war. So again, it's a really huge question. I think in the short term, yeah, it's going to impact the market. The question is that a week, a month, 6 months, or a year? And I don't think any of us know the answer to that right now.
I mean, these fuel spikes, though, have proven in the past to be major catalysts for market reversal, right? I mean, they've kind of been coincidentally happening around the time when markets were poised to flip anyway. But, we've seen short-term bumps in fuel drive markets downward in the past.
Well, yeah, 2005, Katrina, the Great Recession was right around the corner, and 2008, yeah, you're right. Rising fuel does a lot. I mean, we don't have to raise interest rates, I don't think, as the Fed, because when you increase everybody's cost of buying commuting gas by $3,000 to $5,000 a year, that's more than a 1 point increase on interest rates. So it just depends how long this lasts. Is this short term, or is this going to be around for a while?
So, I mean, mechanically, right, if you have fungibility between spot and contract, let's say you're operating a small fleet of trucks and you kind of are lower down the routing guide, it would be more advantageous right now for you to go where you have a set fuel surcharge, right, versus where you're negotiating in the spot market for your all-in rate. Is that one of the things you think that drive folks over to the spot market, or away from the spot market, I mean?
Yeah, in the end, it's all supply and demand, right? So it depends where the trucks are. So if a lot leave the spot market and go into the contract to market, and I think shippers are waiting for this moment, right? They want to lock up capacity at a reasonable rate as opposed to what they've been paying for the last 2 years. And so if they say this is the time and they can lock up a bunch of capacity, I've heard this is a great time for us at ATBS. We have our year-end benchmark data. We've visited over 50 carriers in the last 3 weeks. And what I hear carriers saying, really until 3 weeks ago when this war started, shippers are saying, let's just not talk about rate. Like, be reasonable on the rate. What I really need to know is how many trucks you can give me, because I have to commit to my CEO that we're going to have capacity to move our stuff. So take rate out of the equation. You've never heard that in trucking, right? And so, maybe we're at a time where the shippers can negotiate some reasonable long-term rate contracts, and maybe carriers are scared because they're paying a ton of money right now, and so maybe we are at that top. Maybe so.
Todd, one of the things on our last show, you talked about what great year 2021 was for carriers and some of the best numbers. I think you said it in 3 decades or something to that effect. And I was struck yesterday listening to Sirius XM on the drive down here to Louisville. We had an owner-operator on saying that with rising diesel prices, owner-operators can't afford to feed their families, which I thought was I couldn't quite get my head around it, how such a short-term change in diesel prices over a matter of 3 or 4 weeks could have such a profound impact against the backdrop of what sounded like, in most sectors, a really good year in trucking. Do you think that was just sort of people making some noise, or do you think there's a genuine concern that some parts of the industry where the fuel surcharge is not part of their calculation, they get a fixed rate, that it actually is hurting them that much?
Yeah, I think a bit of it is a flip reaction to a crazy situation, right? So when you take the $1.15 rise in 2 weeks that happened, that's $400, 20 cents a mile to the average owner operator. So $400 is 20 grand a year. If we look at our numbers last year, our average owner operator went from making 67,000 2 years ago to making 71,000 last year, the average. But we have drivers that were making 250 grand. If you wanted to work last year, our average driver ran 10% less miles last year. They didn't manage fuel costs because they didn't care, because the sky was the limit for money. I could drive as fast as I want. I could idle. So there's a lot that can happen to keep me in business and keep me making money. We actually just have to get back to managing our business, which all industries and all businesses are that way. When revenue's good, when economy's great, we kind of forget about managing the business, and it's just guns a-blazing. Let's go generate as much revenue as we can, and our bottom line takes care of itself. So, we're now in a time where we have to slow down. We can't drive 75 miles an hour. Maybe we have to drive 65. Maybe we have to idle less. If you throw in just a few of those things, we can offset the $20,000 increased cost of fuel if rates stay the same. But rates aren't going to stay the same. They can't. I mean, nothing has fundamentally changed from a month ago when we had a big shortage of trucks, and they're not coming anytime soon. We still can't produce them. We still can't find the drivers, right? So unless this war fundamentally changes our economy and the freight moving, we're going to be back to normalized time in a few months when this settles down a bit, I think. But who knows, right? It's a crazy time.
So, I mean, I think the one thing to consider, right, the one thing that's fundamentally changed is if shippers' budgets were theoretically maxed, the increased money they're paying in fuel would necessarily have to decrease what they're able to pay in the base, right? So that's just going to drive those rates. And that's pretty much what we're seeing, is that they're essentially taking over 100% of that fuel price increase out of the base rates, because total rates have kind of middled about, if not fallen a bit, across both sides. So it seems like we were up against that ceiling, if you will. of like, because we're seeing increased load factor. Shippers are just kind of really trying to get their piece counts up and do everything they can to move less truckloads and make them as full as possible.
Yeah, but I heard stories as short as a month ago where shippers were breaking a truckload into 3 expedite trucks, right? So they're paying $25,000 to move something across the country that would have cost them $4,000 because they got to get the product to market, right? The shelves are still bare. We still can't buy them.
Yeah. I think the counterpoint to that too becomes retail spending is looking a lot worse than it did even a month ago, right? So, I mean, when you were charging these crazy premiums and the shelves were empty, it made a lot of sense to do that. If things slow down and people aren't buying Pelotons by the half dozen, I think we get to a point where, I don't know, we'll see. This fuel thing, I think it's a psychological. I mean, because for me, like we have 2 cars, we drive, I don't know, maybe 20 minutes to work each day, if that. I mean, it's like $100 and some bucks a month extra. It's not that big of a deal. But I think more psychologically, people tend to like curtail their spending when they see price at the pump and especially price at the grocery store start to go up. Yeah, so we'll see.
Yeah.
Well, I think, it's never the same, but we can learn from history. And if you think back to March 2 years ago when COVID hit, it was great recession, depression, disaster levels for 2 months, right? We freaked out. We stopped buying. Well, we hoarded and then we stopped buying. And then we realized this is probably going to be somewhat okay. And we normalized. And, so are we in a, March, April freak out like we did in COVID 2 years ago, and then we get back to normal, or fuel stays high? You're right, Ken. For me, fuel, my commute, I'm going to spend $7,000 a year on fuel right now instead of $5,000. That's not a huge deal, but I think about a lot of the people I work with that make $50,000 or $60,000 a year, and you got $2,000 or $3,000 to their commuting fuel budget. They got to cut somewhere, and that's the whole America, right? So we will stop spending if this continues.
Yeah, I grow. A lot of the industries that we touch, right? we Dean and I spend an inordinate amount of time talking about the building industry and flatbeds. I think I'm hearing a lot that these things are starting to slow down, right? Whereas this time last year, contractors were buying entire home cul-de-sacs worth of lumber at once, right? Because they knew they'd have no problem moving through it. When you have Jay Powell talking about enough is enough with inflation, and you're looking at 5-6% 30-year mortgage rates maybe by the end of the year, and lumber's back kind of under the radar. We haven't been talking about it as much. Lumber's back to near the highs that it was last year, right? Things are, and again, this isn't a doom and gloom show, but right, things are sort of teetering, I feel, at the moment in terms of like macroeconomic conditions.
Yeah, if you look through history, trucking cycles, typically the big cycle is 12 to 18 months. We buy a bunch of trucks, we had a bunch of drivers, we have too many trucks. Even though the economy's okay, things are not good for truckers for 3 years, and then we do it all over again. And it hasn't been normal really since the Great Recession, but we've been in almost a 2-year boom for trucking, like a boom like we've never seen. It's a boom beyond a boom, right? So we're due any day for things to slow down in trucking. But again, I've been with 50 of the biggest truck lines in America the last 4 weeks, and 0 of them are predicting that this slows down until 2023. Again, that was before the war for the most part, right? So if things normalize, I think we still have a good year. If fuel stays high for all of us, it could have an impact.
Just one quick point to that, though. Normally, when you have these kinds of like boom bust cycles, the reason why the boom turns into a bust is because you have overproduction of capacity. And I think that's one of the reasons why the boom has gone on so long, is that there hasn't been the ability to overproduce capacity because there's been such a shortage of trucks and because there's been such a shortage of drivers. Like, there's just not enough new entrants and new capacity entering to like eat up all the grain, as it were.
Yeah, and I think probably the super interesting thing is the capacity. Dean and I discuss this often, but the capacity that has been created is the one truck driver getting their own authority, right? And that's like herding a bunch of cats. They're not out negotiating long-term 3-year rates with fuel surcharges with Procter & Gamble and Walmart. And so, but they maneuver around, right? When things get difficult and they can't make money in the spot market, then they want to go to operate for those big motor carriers that have those long-term contracts with, but there's still $1.50 30 spread between spot rates and what I'm going to make running for a carrier.
Mm-hmm.
In our mind, it's about a 50-cent break even. So we're still 80 cents above where it makes sense for me to go run for a motor carrier in this market. Until we get down to 60 to 65 cents on that break even, they're going to keep chasing spot freight. They are.
Mm-hmm.
I love that. That's why I love having you on. That's just such great insight. I mean, it's such actionable insight. So I had a question, Todd. When we think about interest rates, right? We talk a lot about home, but home mortgages and commercial properties. But if you're out there looking to get a new truck, right? It's been difficult to buy a new truck, obviously, over the last couple of years. And interest rates, the prime rate does go up to 2 whole percentage points. How does that impact? Obviously, it erodes your profit margin, but how much, in the pantheon of insurance, your truck payment, your fuel, your other operating expenses, how does that all shake out?
And I haven't done the numbers. I read something really smart the other day. Some realtors said that for every 1% interest rates go up, housing prices go down 10%. That's a economic formula. If you tried to equate that to trucking, you could easily do that. But the thing in trucking, you said it a minute ago, the average used truck at $110,000. That's insane. And banks are not dummies, right? So they're not financing 10% down on a used $110,000 truck because they know when the market corrects, that truck's going to be worth $45,000, $50,000 again. So you got a lot of people that are paying 50% down on those trucks right now because the banks are demanding it. So to be honest, I don't know. I don't want to throw us in a controversial conversation, but the Fed has figured out for us how to not ever have pain again in our lives. I think since the Great Recession, they cannot raise interest rates a lot. They just can't because we have a $30 trillion deficit. Every 1% that interest rates go up is $300 billion in payments on our debt. So whether we like it or not, interest rates can go up a lot, even though they need to. So I don't think interest rates are a concern for buying my next truck if I got to pay a couple points more. The concern is the inflation we've experienced in those truck prices.
Yeah, I mean, that's kind of a discussion we're having now is that how tied are the Fed's hands, right? I mean, because it's easy to quell inflation. To your point, you just raise interest rates. It's tried and true. The question becomes, what's the collateral damage of doing that in terms of long-term economic growth? Because, I mean, we've been spoiled with the longest period of rapid economic growth in the history of America over the last couple decades, right? So at a certain point, I mean, they're going to have to make some hard decisions, I would say, because I can't imagine that the average American is going to be able to withstand $5 a gallon milk, right? Because the gas, my kind of glib response to the gas is that the price per gallon of milk is a lot more important to most Americans than the price per gallon of gas. Because I still think at $5 a gallon, it's a hell of a value. With your average American mid-sized car, the fact that you can drive 30 miles on $5 is, to me, still remarkable. It's just, I have 3 boys. They're young still, but I'm paying $300 a week at the grocery store. I mean, it's...
Yeah.
And maybe some of the remote work has mitigated some of the fuel pinch, right? I think a lot of Americans are still, even a couple days a week, working from home, but they're still buying groceries and mattresses and soap and the microbeads. Everything is just incredibly high. Tires, right? I mean, tires, I was just reading an article that you don't buy tires very often, so I don't think most people kind of keep tabs on it, but tires are ridiculously expensive, all-time high for tires.
Yeah, Todd, at the point we slow down our buying, right? We have no choice.
Todd, based on your benchmarking data for last year, how much would you say that the operating costs have increased over the last year, given all of the rises in inflation due to supply chain shortages and then inflation at the back end of the year?
Yeah, Dean, it's fresh in my mind because we've been talking about it. So they're up 20 cents a mile, which is roughly $20,000 a year. You can attribute about $14,000 of that to fuel because not only did it just go up, it went up all of last year. About $6,000 of that is fixed costs, things like truck payment and insurance. So again, put that in perspective. All of last year, operating costs went up 20 cents a mile, or roughly 20 grand, which is the highest they've ever gone up in any year. Usually in a bad year, it might be 7 or 8. And we doubled that with fuel in the last 2 weeks. We just doubled what happened last year with fuel. Our operating costs are now up 40 cents year over year. So we have to offset that cost. We have no choice. That's going to come in rates.
Yeah. The increase. I mean, the gross margin's been eaten away, in particular in the last few weeks. My numbers on running my trucks show that we're down from about 60 cents a mile this time a year ago in terms of gross profit per mile, down to about 18 as a result of the fuel increases in the last couple of weeks. So even though rates are sort of still at very high levels, those margins are being eaten away really, really quickly.
Yeah.
And you're not going to run trucks for 18 cents a mile. There's too much risk in this business for 18 cents a mile. And everybody like you is the same. So you're either going to park your truck or you're going to demand a higher rate. And there may be a bit of both, right?
Yeah.
All right, I'm going to move. We're running up against some time here. I do have one question for Ned. And Ned, if you can kind of just touch on it quickly, because we were having a lively internal debate. I think it was earlier this week or late last, and someone on our team was clearly trying to make a point, and they were going to try to pull some ratecast history that basically just showed that ratecast can't predict these type things. But in actuality, much to his and our surprise, it really did. Can you just talk for a minute about how, ratecast sort of saw the seasonality and the freight cycle exerting itself here? So it was kind of right for some of the different reasons.
So I want to start off by we're talking about the long-term forecasts that were made in the early part of this year, not the short-term.
Correct. Yeah.
Because it's important to disambiguate there. The long-term forecasts have been expecting some kind of a market correction for a while. I would say that normally the seasonality is slightly in this direction, but this is much deeper than ratecast would predict. But overall, ratecast had an expectation that things were going to drop in March, and I was pleasantly surprised by that.
Yeah, it was an odd seasonal cue, right? Because typically you'd expect February. So it was interesting that it was pushing that correction back. And like I said, it didn't see fuel coming, but it just kind of sensed that. And to me personally, fuel sort of tipped us towards that seasonal downtick. So it'll be really interesting to see what happens over the next few weeks, because we should start to see that spring pressure build with reefers and dry vans, especially, to see where those rates normalize. Because my opinion, again, we're going to drift into opinion here for a second, and Dean and I have been watching this closely. I think if we get to a point where base rates flip year over year negative, all hell's really going to break loose in terms of a rating perspective. I think that's what could just push a massive glut over to the contract market and take all the wind out of the sails. But it's not there yet. Well, we still have 12, 14 cents, Dean?
Yep.
12 to 14 cents, and quite a bit more on the reefer side. But we're closely watching that. A lot of this business for brokers and shippers is managed on year-over-year comparisons. We've been talking about that. This is our 94th episode we talked about. We've probably mentioned that in well over half of them. So when those year-over-year comps start to flip negative, I do think we're going to be in for some thrash. So I want to thank Todd. I would love to ask you to come on at a minimum quarterly, because these are some of the best conversations. Either you're making them up and you do a really good job of being believable, or you just have memorized these outstanding facts and figures. Either way, I'm a huge fan.
Do you have time for one listener question before we go?
Sure. Yeah, real quick.
Yeah, Robert asked, from week 1, 2022 to current state, what is the national average downtick for a dry van spot from an RPM perspective nationally? And Dean helpfully went and pulled that. It's 31 cents a mile drop, year-to-date dry van line haul spot down.
Woof. Okay. Any last-minute comments, Todd?
Been doing this a long time, and at a time like this, we start talking about fuel before, or just getting to the point where it needs to be managed. We got to give people hope and confidence right now. It's a scary time. Things are going to level out. It's like just pretend it's COVID and it's fuel instead of COVID. It's March 2 years ago when we all thought the world was going to end. By June, things I believe will have calmed down. So, have a steady hand. Keep doing what you're doing. Think about your costs. Nobody's worried about costs for a long time. So manage the business. Just get back to running a really good, solid business, and the rest will take care of itself. And thanks everybody for what you do. God bless you. You're the heartbeat of America, and we love the truck drivers.
We do. And that's a great segue, because Dean is at Matt's. I'll save all the other plugs this week and just say go see Dean if you're at Matt's. We have a really great presence there. We're sponsoring the big concert. We'll actually have a few product folks walking around demoing the thing Ned and team has been working on, one of our new rating methodologies. So we shipped them an iPad so they can sit there and run all the quotes. So if you're at Matt's, go see Cole or Dory or Dean or any of our team that'll be down there. I think even we have executives that are flying down to see Matt's in person. So it'll be fun. And with that, we will sign off because we are running long. I wanted to thank Todd. I want to thank Dean for dialing in, even though he's about ready to go get his Mid-American Truck Show on. And with that, we will see you next Tuesday at 10 Eastern. Bye, everyone.
Bye.